Most people who start investing in 2026 will lose money. And I'll tell you right now, it won't be because the market crashes. It won't be because they pick bad stocks. It'll be because they do things in the wrong order. And by the time they figure that out, the damage is already done. Today I'm going to show you the exact sequence, step by step, that takes someone from $0 in assets to their first 100,000 and eventually their first million. But I have to warn you up front. The first move has nothing to do with the stock market. And if you skip it, every dollar you invest after it will work against you. Now, if this is the kind of conversation you want to have more often, and honestly, you should, go ahead and hit the subscribe button right now so YouTube keeps sending you more of this. It takes 2 seconds and it genuinely helps. Okay, let's get into it. Let me start with a number, 0. No savings, no stocks, no assets of any kind, just a job, a few bills, and a financial world that seems designed to confuse you. Now here's what I want you to understand. 0 is not the problem. You see, most people think starting at 0 means starting behind, and it doesn't. Starting at 0 with the right sequence is actually cleaner than starting with $100,000 and doing things in the wrong order, and I can prove it. Because here's what most people with $100,000 actually have. $60,000 locked in a 401k they can't touch without a penalty. $15,000 in a brokerage account they panic sell every time the market dips. And $25,000 in credit card and auto debt, quietly compounding against them at 20% interest. Now, that person is not ahead of you. That person is losing. And the reason they're losing is the same reason most people who start investing this year will quietly fail within 18 months. They don't know the sequence. So here it is. 4 phases. The foundation, the engine, the portfolio, and the tax shield. Miss any one of them, or do them in the wrong order, and the whole thing falls apart. And let's start with the one that almost nobody wants to hear. Okay, so if you're starting at 0, your actual net worth right now is probably not 0. It's negative. And until you deal with that, putting money into the stock market is one of the worst financial decisions you can make. Here's why. The stock market returns around 10% a year on average. That's the number everyone uses. That's the historical figure. Your credit card is charging you 20, 24, sometimes 29% every single year. So the moment you invest $1 instead of paying off that card, you are voluntarily losing the gap between those two numbers. You see, you're paying 24% to earn 10%. And there is no fund, no ETF, no index on earth that makes that math work in your favor. Now here's the part that really stings. Say you've got $5,000 on a card at 24% interest. If you only make the minimum payments, by the time that debt is gone, you will have paid back close to $10,000. Double. And it's purely because of time. Meanwhile, you clearing that debt is the only guaranteed 24% return that exists anywhere in finance. The market can't promise you 10%, but paying off high-interest debt pays you 24%. Every time. 0 risk, 0 volatility, 0 waiting. So in phase 1, forget the stock market. You are not an investor yet. You are a debt destroyer. And the method is the debt avalanche. You list every single thing you owe from the highest interest rate to the lowest. Ignore the balance size completely. You only care about the rate. Throw every spare dollar at the highest rate debt. Minimum payments on everything else. Sell things you don't need. Cut every subscription that isn't essential. Treat this like the building is on fire, because financially, it is. Now here's the part most people never think about. Debt doesn't just cost you money. And this is important. It costs you nerve. When you owe money, you don't ask for the raise. You don't take the career risk. You don't move to a better city for a better opportunity. You stay exactly where you are because you can't afford to lose what you have. So clearing this debt is not just a financial move. It unlocks the ability to make every other move on this list. But once the debt is gone, most people make a mistake that wipes out everything they just worked for. And I need to show you exactly what that looks like before you walk into it. Here's the scenario. You clear your debt, you start investing. Every month, money goes into the market. You feel good about it. Then your car needs a major repair, or a medical bill shows up, or you get laid off, and your money is tied up in the market. And the market is down 20% that week, so you sell, at the bottom, to cover the emergency. You just locked in a permanent loss, and you just destroyed every bit of compounding you spent months building. That is the emergency trap, and it is how the majority of new investors blow up their portfolios in the first 2 years. The fix is a cash buffer. 3 to 6 months of your bare minimum living expenses, rent, food, utilities, basic transport, sitting in a high-yield savings account before you buy a single share of anything. Now, I know what you're about to say. Cash is trash. Inflation eats it. I need to be fully invested. And look, that's technically true in the long run. But here's the thing you're missing. Cash right now is not an investment. It's protection. And those are two completely different jobs. All right, let me show you exactly what that protection is worth in real terms. 2 investors. Same starting point. Same monthly contributions. Investor A puts everything into the market, fully invested all the time. Investor B keeps $10,000 in a high-yield savings account. The market drops 20%. Both investors lose their jobs the same week. Investor A has to sell at the bottom to pay rent. That loss is locked in permanently. The compounding is gone. Investor B uses the cash buffer. Portfolio stays untouched, keeps compounding through the dip. 6 months later, the market recovers. And Investor A is still rebuilding from the forced sale. Investor B never stopped moving forward. You see, the buffer didn't just save Investor B money, it saved the entire trajectory. And there's a deeper layer to this that the math alone doesn't capture. When you have 3 months of living expenses sitting in a high-yield savings account, you walk differently. You negotiate differently at work. You don't take the first offer they put in front of you. You walk away from bad situations because you can afford to. The cash buffer doesn't just protect your investments. It changes the quality of every single decision you make. And without it, you're one bad month away from panic. The market will punish panic every single time. Every time. So calculate your bare minimum monthly number. Multiply it by 3. Open a high-yield savings account. In 2026, these are paying real interest, and they're genuinely easy to find. Automate a transfer every payday until that number is hit. Then treat it like it doesn't exist. It is for survival only. Now, debt gone, buffer built. You're finally ready to invest. And this is exactly where most people make the mistake that quietly guarantees them average results for the rest of their financial lives. Okay, so when new investors finally get money into the market, the first thing they want to do is spread it around. A little crypto, a little gold, a few individual stocks, some international exposure. They've heard that diversification is smart, so they diversify immediately. And here's what they don't realize. Diversifying a small portfolio doesn't protect you. It practically guarantees mediocrity. Here's the problem. If you have $500 a month to invest and you split it across 10 positions, each one gets $50. $50 in crypto is a lottery ticket. $50 in gold is a rounding error. And nothing compounds fast enough to matter. The rule is this. You need concentration to build wealth. You need diversification to protect it. And those are 2 different jobs for 2 completely different stages of the game. Right now, you are in the building stage, which means concentration. And the place to concentrate your early capital is the investment vehicle with the most proven, most consistent long-run track record in the history of modern finance. The total stock market index. Now, before you close the tab, I know that sounds boring. That's the point. Here's the data that should settle this permanently. Every 15 years, more than 90% of professionally managed funds, run by people with research teams, Bloomberg terminals, and decades of experience, fail to beat the S&P 500. 90%. These are people paid millions of dollars to find better investments than the index. They have more information than you, more time than you, more resources than you, and they still lose to the index the majority of the time. So the idea that you, with a full-time job and a phone, will consistently outperform the market through stock picking, that's not a strategy. That's a wish. And wishes don't compound. So here's the protocol. 90% of your investable money goes into low-cost broad market index funds. Total US market. Some international exposure. You automate it. You set it, and you genuinely leave it alone. The remaining 10%, and I mean strictly 10, you can use however you want. A specific stock, a small crypto position, whatever interests you. If it goes to zero, your financial plan survives. If it goes up, great. That 10% is your pressure valve. It scratches the urge to act without blowing up the whole plan. Now, even if you invest perfectly, there is still something quietly draining 30% of everything you build. And most people never see it until it's far too late. Taxes. And I don't mean an audit. I don't mean a penalty notice in the mail. I mean the slow, invisible drain of building wealth in the wrong type of account for 30 years. Here's how it happens. You open a brokerage app. You link your bank. You start buying index funds. You feel great about it. But unless you specifically chose a tax-advantaged account, you just opened a standard taxable brokerage, which means every profit you take, you pay capital gains tax. At every dividend that hits your account, you pay income tax on it, year after year, quietly, automatically. Over 30 years, that tax drag is a massive chunk of your potential wealth handed to the government. Because you didn't know the order of operations. Let me show you the exact number. You invest $10,000. It grows to $100,000 over 30 years. In a taxable account, when you pull that $90,000 gain, you could owe the IRS up to $18,000. And that's from choosing the wrong container. That's it. Now run the same scenario in a Roth IRA. Same money, same 30 years, same 100,000. You withdraw it. Zero tax. You keep the full 100,000. That $18,000 difference has nothing to do with being smarter or picking better stocks. It comes purely from knowing which account to use first. And if your employer offers a 401k match, that's even more urgent. Because an employer match is a 100% return on your money before it's even invested. The market can't give you that on day one. So here's the order, and the order matters. Step 1. 401k. Enough to capture the full employer match. Every dollar they match is a dollar you cannot replace anywhere else. Step 2. Max out your Roth IRA. Tax-free growth, tax-free withdrawal. Step 3. If you're on a high-deductible health plan, fund the HSA. It's the only account in the tax code that's triple tax-advantaged. Tax-free going in, tax-free growth, tax-free coming out. Step 4. Go back and fill the 401k the rest of the way. See, and only after every one of those buckets is full does a single dollar go into a regular taxable brokerage. That order is the tax shield. Most people skip it because the brokerage app is right there on their phone and starting feels easy. Easy entry. Expensive exit. Get the order right and you keep significantly more of what you build. Now, here's the thing. You can do every single thing we just talked about perfectly. Debt cleared. Buffer built. Right accounts. Right funds. And you can still hit a wall. A hard one. And it's probably the last wall you'd expect. There is a ceiling on how much you can save. Think about that for a second. You can cut your expenses down to the absolute minimum. At some point you hit the floor, rent, food, transport, utilities, and there's nothing left to cut. But here's what changes everything. There is no ceiling on earning. Your expenses have a floor. Your income has no ceiling. And that gap, that complete asymmetry, is the most underused advantage in personal finance. Because in 2026, you cannot save your way to wealth on a $40,000 salary. Inflation moves the target. The cost of housing and food keeps climbing whether you're optimizing or not. And if you're playing a purely defensive game, cutting here, trimming there, you're playing not to lose. Playing not to lose is not the same as winning. At some point, you have to go on offense, and offense means income. Now, the typical advice here is to start a side hustle, drive for a rideshare, sell things online, freelance on weekends. And look, those things are fine, but they all share the same problem. They are linear. You trade an hour, you get paid. You stop, you get nothing. That's a second job you happen to hate. It's not a wealth engine. What actually moves the needle is what I call a high leverage skill. Something you get genuinely good at that permanently raises your primary income. And I don't mean $20 an hour on a Saturday. I mean $20,000 or $30,000 a year added to your salary. Recurring. On top of what you already make. Now here's why that matters more than it looks on the surface. A salary increase doesn't just put more money in your pocket. It raises your 401k match. It raises your future Social Security credits. It raises the baseline that every future raise gets calculated from. You see, the compounding effect of a higher income is not just the number itself. It's everything that number touches going forward. Learning a new skill is uncomfortable. That's just true. It's easier to download a rideshare app than it is to spend 90 days learning data analysis or technical sales or whatever your industry actually pays premium for. But low friction always means low barrier to entry. And low barrier to entry means everyone can do it. And when everyone can do it, the pay reflects that. The skills that pay the most are the ones most people won't go through the discomfort of learning. So here's the protocol. Look at your current job and ask one honest question. What is the single skill, the one thing, that if you got genuinely good at it, would make you harder to replace and easier to promote? Maybe it's learning how to present data to decision makers. Maybe it's mastering the software that's becoming standard in your field. Maybe it's getting comfortable in front of a room when nobody else at your level is. 1 hour a day. The hour you're already spending scrolling. Give it 6 months. Then use it to ask for a raise, apply for a better role, or build something that scales beyond your time. Because a 20% savings rate on a $100,000 income is not the same as a 20% savings rate on $50,000. The rate is identical. The outcome is a completely different life. Okay, let's close the loop on the full sequence, because I want you to see the complete picture before you go. Phase 1. Destroy the high-interest debt first. Avalanche method. Highest rate to lowest. Every spare dollar thrown at it. And clearing it doesn't just fix a number. It gives you the freedom to take the risks that actually build wealth. Our Phase 2. Build the 3-month cash fortress before you invest a single dollar. Bare minimum monthly expenses multiplied by 3. High-yield savings account. Automated transfers. Untouched until a real emergency. This is what keeps you from selling your investments at the worst possible moment. Phase 3. Fill the tax-advantaged accounts in the right order. 401k to the full employer match first. Then the Roth IRA. Then the HSA if you qualify. Then back to the 401k to fill it up completely. Regular brokerage account comes last. Always. Phase 4. Invest 90% in boring, low-cost index funds and leave them completely alone. 10% for whatever you want to experiment with. Automate everything. Check it quarterly. And underneath all of it, run the offense. Invest in the skill that raises your primary income permanently. Because every dollar of income increase accelerates every single phase of this plan at the same time. Now, this plan is not exciting. There is nothing here that goes viral. But here is what it does. Follow this sequence for 5 years, and most people are looking at 50 to 100,000 in real invested assets. 10 years and the math starts doing things that are genuinely hard to believe. 20 years and compound interest has had enough time to show you what it's actually capable of. And the reason most people never get there has nothing to do with intelligence or income or luck. It comes down to sequence. They invest before the debt is gone. They skip the buffer and sell at the bottom. They use the wrong account and hand away decades of tax-free growth without realizing it. They diversify too early on too small a base. They optimize saving when they should be growing income. Fix the sequence, get the order right, then get out of the way, because compound interest doesn't need your help. It just needs your patience, and it will do the rest. If this conversation gave you something real today, and I believe it did, go ahead and subscribe and ring the notification bell so you don't miss what's coming next. We cover things on this channel that most people spend years figuring out on their own. You don't have to. Subscribe, ring the bell, and I'll see you in the next one.